Exposure are rights to variable returns from an investee. Variable returns are the returns that are not fixed and have the potential to vary as a result of the performance of an investee. Variable returns can be only positive, only negative, or both positive and negative. An investor assesses whether returns from an investee are variable and how variable those returns are on the basis of the substance of the arrangement and regardless of the legal form of the returns. For example, an investor can hold a bond with fixed interest payments. The fixed interest payments are variable returns for the purpose of control evaluation because they are subject to default risk and they expose the investor to the credit risk of the issuer of the bond. The amount of variability, that is, how variable those returns are, depends upon the credit risk of the bond. Similarly, fixed performance fees for managing an investor's investee's assets are variable returns because they expose the investor to the performance risk of the investee. The amount of variability depends upon the investee's ability to generate sufficient income to pay the fees. However, a non-refundable income received from the investee, which is not impacted by the credit risk or performance of the investee, can be considered as a fixed return. It must also be noted that the term returns includes within its scope both direct returns, which are mostly financial returns, as well as synergetic returns, which are more indirect. Following are some of the examples of variable returns. Variable returns from an investee includes dividends, other distributions, example interest from debt securities, changes in value of investors' investment in that investee, remuneration for servicing and investees' assets and liabilities, fees and exposure to loss from providing credit or liquidity support, residual interest in the investee's assets and liabilities on liquidation, tax benefits, access to future liquidity, returns that are not available to other interest holders. Example, an investor might use its asset in combination with the assets of the investee, such as combining operating functions to achieve economies of scale, cost savings, sourcing scarce products, gaining access to proprietary knowledge, or limiting some operations or assets to enhance the value of investors' other assets. Link between power and returns. An investor controls an investee if the investor not only has power over the investee and the exposure or rights to variable returns from its involvement with the investee, but also has the ability to use its power to affect the investor's return from its involvement with the investee. For example, it is common for a lender to have an exposure to variable returns from the borrower through interest payments that it receives from the borrower that are subject to credit risk. However, the lender would not control the borrower if it does not have the ability to affect those interest payments, which is frequently the case. Thus, an investor with decision making rights shall determine whether it is a principal or an agent. An investor may delegate its decision making authority to an agent on some specific issues or on activities, all relevant activities. When assessing whether it controls an investee, the investor shall treat the decision making rights delegated to its agent as held by the investor directly. What is the relationship between other parties? When assessing control, an investor shall consider the nature of its relationship with other parties and whether those other parties are acting on the investor's behalf. That is, they are de facto agents of the investor. The determination of whether other parties are acting as de facto agents requires judgment, considering not only the nature of the relationship but also how those parties interact with each other and the investor. A de facto agent relationship does not require a contractual arrangement between the investor and the de facto agent. A party is a de facto agent when the investor has, or those that direct the activities of the investor have, the ability to direct the party to act on the investor's behalf. An investor shall consider its de facto agent's decision making rights and its indirect exposure or rights to variable returns through the de facto agent together with its own when assessing control of an investee. For example, an investor holds 30% voting power in an investee. One of the fellow subsidiaries of the investor also holds 30% voting powers of the investee. If the investor believes that if it has the ability to direct the fellow subsidiary to act on behalf of the investor while exercising its voting rights, then the investor may conclude that the fellow subsidiaries is a de facto agent of the investor. Accordingly, investor would be able to control the investee with ability to use 60% of the voting rights. However, in the case of fellow subsidiary holds just 10% voting rights of the investee, then the investor would not be able to control the investee with just 40% voting rights. That is 30% held by investor itself and 10% owned by de facto agent. Following are the examples of other parties that, by nature of their relationship, might act as a de facto agents for the investor. Example number one, investors related parties. Next, a party that received its interest in the investee as a contribution or a loan from the investor. Next, a party that has agreed not to sell, transfer, or encumber its interest in the investees without the investor's prior approval, except in case investor or other party have right of prior approval and rights are based on mutual agreed terms. A party that cannot finance its operations without subordinating financial support from the investor, investee for which the majority of the members of the board are similar body are the same as those of the investor, a party that has a close business relationship with the investor, such as the relationship between a professional service provider and one of its significant clients. Parties mentioned above are not necessarily de facto agents of the investor. However, the investor needs to evaluate whether the parties falling in the above categories are the de facto agents or not. Control of specified asset. An investor shall consider whether it treats a portion of of an investee as a deemed separate entity, and if so, whether it controls the deemed separate entity. A deemed separate entity is often called as a silo. An investor shall treat a portion of an investee as a deemed separate entity if and only if the following conditions are satisfied. Determination of whether a portion of an investee is a deemed separate entity. Specified assets of the investee and the related credit enhancements, if any, are the only source of payment for specified liabilities of or specified other interest in the investee. Parties other than those with the specified liability do not have rights or obligations related to the specified assets or the residual cash flows from those assets. In substance, none of the returns from the specified assets can be used by remaining investee, and none of the liabilities of the deemed separate entity are payable from the assets of the remaining investee. For example, an investee is a mutual fund, and under the investee, there are multiple sub funds established with different investment objectives like debt oriented funds, equity oriented funds, etc. In such case, an assessment should be made as to whether the sub funds are deemed separate entities as per the conditions mentioned above. When the conditions mentioned above are satisfied, an investor shall assess whether it controls the silo by applying the guidance of a control evaluation. If the investor controls the silo, the investor shall consolidate that silo. In that case, other parties exclude that silo when assessing control of and in consolidating the investee. For example, continuing with the above example on identification of a silo, if one of the sub funds is treated as a silo, then the investor that controls that silo will consolidate that sub fund. Other parties who control other sub funds will exclude the sub fund controlled by the investor in their control evaluation and consolidation.